Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve is holding the federal funds rate at 3.5 to 3.75% as of today, March 17th, 2026. This is not just another policy pause. This is what analysts are calling a hawkish bias on hold, and it is driving a fundamental sector rotation that is reshaping equity market leadership right now. Market pricing data shows a 97% probability of no rate reduction in the immediate term. According to Connect Money, the Fed has effectively placed its 2025 easing cycle on indefinite hold after 3 consecutive rate cuts earlier in the cycle. Fed Chair Jay Powell stated the current policy rate is appropriate to support both of our goals, signaling a meeting-by-meeting approach with no urgency to ease. Here is what is driving this stance. Geopolitical tensions involving Iran have pushed crude oil prices above $100 per barrel. This creates what economists term an inflation growth dilemma. Higher energy costs threaten to lift inflation while simultaneously pressuring corporate margins and overall growth prospects. The Fed is caught between controlling inflation and supporting economic growth, and they are choosing restrictive policy. This energy shock is not a temporary blip. According to reporting from WGCU and Axios, the Iran conflict is impeding production and shipping, creating sustained upward pressure on crude. For traders, this means the energy sector is not just catching a temporary bid. Energy companies are attracting investors seeking inflation hedges and tangible asset exposure in an environment where duration risk is being repriced across the board. Let's talk sector rotation. Growth sectors sensitive to future cash flow discounting are getting hammered. Consumer discretionary and industrial stocks face particular challenges as prolonged high interest rates compress their valuation multiples. Technology megacaps, previously market leaders, are losing momentum as investors reassess their long-duration growth profiles. The math is simple. Higher discount rates for longer means lower present values for future earnings. According to analysis from Thrivient Funds, defensive sectors are where the money is rotating. Financials are benefiting from improved net interest margins in a higher rate environment. Banks and financial institutions are seeing credit quality improvements that support stronger fundamentals. This is a straightforward play on the yield curve and the profitability of lending in a 3.5 to 3.75% rate environment. The utilities are showing traditional defensive characteristics that make them attractive in uncertain economic environments. Their dividend yields are becoming more competitive relative to growth stocks that offer no current income. When the risk-free rate is elevated and growth is uncertain, income generation becomes a priority for portfolio managers. Energy is the obvious winner here, not just from higher oil prices, but from the broader inflation narrative. Asset-intensive sectors with pricing power are outperforming their speculative counterparts. This is a quality and liquidity rotation, and it is likely to persist. Small caps are getting crushed. Microcap growth stocks are experiencing valuation compression as their cost of capital rises relative to established, cash-generative enterprises. According to Royce Invest analysis on small cap outlooks for 2026, the prolonged high-rate environment disproportionately impacts smaller companies with limited cash reserves and higher financing needs. If you are holding speculative small-cap growth, you are fighting the tape right now. Here is what is interesting about the Fed decision. Despite the consensus hold, 2 Fed governors, Stephen Moran and Christopher Waller, favored a quarter-point rate reduction. According to Connect Money, this dissent indicates some internal debate about the appropriate policy stance. This is not unanimous hawkishness. There is ongoing uncertainty about the optimal balance between inflation control and growth support. The Fed maintains flexibility in its policy toolkit, including the potential to restart bond purchases if economic conditions deteriorate significantly. This backstop provides some market confidence, but do not mistake it for imminent easing. The timeline for the next potential rate cut has shifted from earlier projections of June 2026 to possibly September 2026 or later. Let me break down the investment strategy implications. Portfolio managers are realigning away from growth-heavy exposures toward asset-intensive sectors with pricing power, companies benefiting from higher interest rates, defensive sectors with stable cash flows, and value-oriented investments with attractive current yields. This is not a tactical trade. This is a structural shift in market leadership. According to AI Invest analysis, the Fed's hawkish bias on hold is raising stakes for growth-heavy portfolios. The emphasis on quality, liquidity, and defensive characteristics is likely to persist until clearer signals emerge regarding both geopolitical stability and the Federal Reserve's future policy trajectory. What are the key variables to monitor? Evolution of geopolitical tensions affecting energy markets is number one. If crude oil remains above $100 per barrel, inflation expectations will remain elevated and the Fed will not cut. Inflation trajectory, particularly core measures excluding volatile energy, is number two. The Fed is looking at underlying inflation, not just headline numbers driven by oil. Labor market stability and wage growth trends are number three. If the labor market remains tight and wage growth persists, the Fed has no reason to ease. Corporate earnings resilience across different sectors is number four. Earnings reports will tell us whether companies can maintain margins in a high-rate, high-energy cost environment. The bond market is reflecting this reality. According to AI Invest, the 30-year Treasury yield is hovering around 4.91%. This is not a flight to safety. This is a repricing of long-duration assets in an environment where restrictive policy is the baseline assumption. For crypto traders, this environment is challenging. Higher rates and risk-off sentiment in equities typically pressure speculative assets like Bitcoin and Ethereum. When the Fed is not easing and energy shocks are creating macro uncertainty, capital flows toward quality and yield, not digital assets with no cash flows. Here is the actionable takeaway. This is a defensive rotation driven by fundamentals, not sentiment. The Federal Reserve is not cutting rates anytime soon. Geopolitical energy shocks are creating sustained inflation pressure. Sector leadership has shifted from growth to value, from momentum to quality, from speculation to income generation. If you are overweight tech megacaps and small cap growth, you are fighting the Fed and fighting the energy market. If you are positioned in financials, energy, and utilities, you are aligned with the macro environment. This is not about predicting a recession or a rally. This is about understanding the current policy regime and positioning accordingly. The emphasis on quality and liquidity markers in investment selection is paramount. Companies with strong balance sheets, consistent cash flows, and established market positions are outperforming their more speculative counterparts. According to Seeking Alpha analysis on the FOMC March 2026 rate decision, this fundamental repricing across asset classes represents more than a temporary rotation. It signals a potential structural shift in market leadership that could define investment performance through the remainder of 2026. Watch for the next FOMC meeting and updated economic projections. Watch crude oil prices and geopolitical developments in the Middle East. Watch sector flows and whether the rotation into defensives accelerates or stabilizes. And watch dissenting voices within the Fed. If more governors start pushing for cuts, that could signal a policy shift ahead. Right now, the message from the Federal Reserve is clear. Policy is restrictive, and it is staying restrictive until inflation is convincingly under control. Trade accordingly. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.